Okay. So, David, thanks for the opportunity to present. I apologize for the voice. It's allergy season here in California, so the voice will not be what it should be. And I want to thank you for giving me the invite. I think you guys are doing a great job bringing all this information to the public. So, what I want to talk about today is really very simple. It has to do with the fact that many traders like to blame their losses on poor market psychology or poor psychology on their part. When I wrote the first book in 1982 on trader psychology, I really believed there was such a thing. But now, after many years of trading, after all, I've been trading for 52 years, I've come to the realization that there is no trader psychology. There is personal psychology, which can get in the way of trader results. But in terms of psychology itself, I think it's a waste of time to try and figure out your psychology of the market. Where does psychology come into play? It comes into play in various aspects of performance. When do you get in? When do you get out? Do you have trouble following your strategy? Do you have trouble with stop losses? Do you take small profits and big losses? These are all things that have been attributed to poor psychology, but I don't believe that. I think they are behaviors. So it's a question of having the right market behavior as opposed to the right market psychology. Some people will say that I'm splitting hairs, but I'm really not. Psychology is a much broader institution. It has to do with your personality, with your upbringing, with your parents, with your siblings, with your relationship to society. I don't think trading is all that difficult in terms of psychology, which is why I would call it behavior. If you have the right behaviors, you will make money. If you make money, you will have confidence. If you have confidence, it will give you discipline. If you have discipline, you will have more confidence. That all comes from various aspects of understanding the markets. If it's an understanding of the market, that's all that's required to change your behavior, then you've changed your psychology. It'll work the other way around. So rather than talk about market psychology, I want to talk about various other aspects that go into causing traders to behave in a certain way. After all, you can take the best trading system in the world and give it to a crappy trader, and they will turn it into a crappy system. You can take a worthless system, a basically break-even trading system, and give it to a good trader, and they will make money with it. How does that happen? How does it happen that we have so much technology, much more technology than ever? Traders have gotten everything they wished for, by which I mean lower commissions or no commissions, instant feedback, instant calculation of patterns and indicators, fast quotes, fast order executions, low margins, a wealth of information, new indicators, artificial intelligence, and still most traders lose money. How do I know that? Well, in the 52 years that I've been trading, I've traveled all over the world. I've taught traders in practically every major country, at major exchanges all over the world, stock exchanges, futures exchanges. I've traded in live competitions in front of many, many people. I've been on CNBC, been on Larry King show, been on Wall Street Week, spoken at the Mercantile Exchange, Chicago Board of Trade, New York Stock Exchange, Montreal Stock Exchange, you name it. And everywhere I go, traders are all the same. Professionals, they don't complain. All they need is movement. But the average trader, all they do is complain. Why am I losing money? Why am I not making good decisions? Why do I ride my losses? Why do I not take my profits? Why do I take my profits so soon? The usual standard complaints. And guess what? All the beautiful technology we have, all the great new indicators, the artificial intelligence, it hasn't helped most people at all. Not because of bad psychology, but because of bad behavior. I believe that can be cured with the right behaviors. I tell people, once I show you a trading strategy, one of which I will show today, if you implement that strategy in an organized fashion with a structure, then you've got everything you need. So before I reveal everything, I'm going to go slowly and make this step at a time. So today we're going to try and answer some questions. In fact, let me get my pointer. Just one moment, please. Hang on a second. Here we go. Why do so many traders lose? That's a given conclusion. How do winning traders win? And does trader psychology exist? So let's go to the first and most important slide, of course. You can lose money trading, and that's the disclaimer. So in case you didn't know it, it is possible to lose money trading. A little bit about me. Well, actually, I'm not going to brag about me. This is just some stuff about me that you can look at while I'm talking. It's important to have structure. And if you have a structure, that will automatically take care of a lot of bad behavior, which in turn will take care of a lot of bad trader psychology. What do I mean by structure? Market structure has to have a model. And for me, and believe me, I've made a few 100,000 trades in my lifetime. I know what I'm talking about. Oh, one more thing. Nobody's paying me to be here today, and I'm not paying anybody to let me be here today. This is strictly educational. And David, you're doing a great job bringing education to traders. But as I said before, all of the education in the world is going to be worthless if you don't have a structure. The structure that I use took me many years to develop, and it is called, in fact, let me skip these. Let me skip these for just a minute. Just bear with me. I'm going to come back and get these. Okay. Setup, trigger, and follow through. If there's only one thing that I could teach you today, or any day, it's this. The trading model, setup, trigger, and follow through. If you are not able to fit your trading skills or your methodology or your system or your strategy into this pattern, into this structure, you will never make money consistently. Let's begin with a setup. A setup is a pattern. The good news, there's all kinds of patterns in the markets. What do I mean by a pattern? A seasonal is a pattern. A cycle is a pattern. Fibonacci is a pattern. Elliott wave is a pattern. Flags, pennants, triangles, breakouts, reversals, key reversals, DMI, stochastic. These are all patterns. The good news is there's thousands of patterns and there's more of them every day. The bad news, 95% of them or more do not work. They don't predict anything. They have no predictive validity. They don't tell you what's likely to happen tomorrow. So looking for the right pattern or setup is like finding a needle in a haystack. That's where most people become frustrated, and that's where their trading goes to hell. They start using patterns that people talk about without understanding them. People say, there is a divergence pattern going on. Okay, good. What the hell does that mean? How does a divergence pattern tell you anything? You don't know that until you put it on the computer and try it and ask the question, does this pattern have predictive validity? Does it predict anything? In most cases, the answer is no. But if you take a pattern and you combine the pattern with the trigger, then it becomes meaningful. So if you take, for example, a reversal or a key reversal, it's an algorithm. The low of today is lower than the low of yesterday, and the high of today is higher than the high of yesterday, and the close of today is higher than the close of yesterday. That's an algorithm. It's a pattern. In and of itself, it has no predictive validity, but add to it a trigger, in other words, closing above the high of the reversal day, then it becomes a predictable pattern, and you can use it. That means it's timing. So you take a pattern, you add timing to it, and then you get into phase 3 of the structure, which is follow through. Follow through consists of 3 parts. Where are you right? Where are you wrong? And how do you maximize the profitability when you're right? So if you can take what you're using and put it into this structure, it means that it will probably work. If your structure won't allow you, if the method you're using won't allow you to put anything into this structure, you are going to lose money, or you are losing money, or you're going to lose a whole lot more. So the goal is to take the structure and fit the pieces into the structure. I'm going to show you some of that today. I'm going to skip back to the beginning here for just a minute and talk about a few other things. So I get tons of email from traders all over the world who are frustrated. Examples like this, people who've been working on the market every day. They come home from their office, they sit down, they look at the charts, they read the charts, they understand the charts, they read newsletters, they go on CNBC, and all of that information adds up to nothing. Why? Because they don't have the structure, and they don't have the steps, and they don't have the procedure. The procedure, as I will show you today, does not have to be complicated. If it's not complicated, it's better. I'm a minimalist. I want the least amount of information on a trade, not the most amount of information. I don't use candlesticks, not because they're not pretty, but because they have too much information for me. The problem is not enough information, too much information. When I first started trading in 1968, 67, there was very little information available. There were just a few books about trading. That was a much better time because you didn't have as much confusion. And so I get letters like this all the time. People are frustrated. They need information on what to do. So the problem is this: TMI, too much information. Now let me show you something else. I use the KISS method, which you're all aware of. Keep it simple, stupid, right? Keep it simple, stupid. I've added something to it. I call it KISS off, which means keep it simple, stupid, or fail forever. I will get phone calls like this or emails like this. Jake, the monthly chart on S&P is heading higher, so it's a bull market. The weekly chart just turned lower. The daily chart is turning bullish. The stochastic just gave a buy signal. So I went to the intraday chart. The 30-minute chart says buy. The 15-minute chart says sell. The 5-minute chart just turned bullish. And I'm looking at the seasonal chart now. The seasonal is up. What should I do? The answer: get a psychiatrist. You'll need one because that's the psychology of trading. You will need a shrink if you use too much information. So we're going to keep it simple, stupid, or fail forever. That's my motto. So what I want to do is this. I want to take patterns, express those patterns as a rule, put that structure on the computer, and let the computer tell me what to do based on the rules. Because if the computer can understand it, it can be programmed. If it can be programmed, it means it's clear. If it's clear, there's no interpretation. So in what I do is I don't analyze anything. In everything that I'm going to tell you today, you will never hear me say it's because of the Middle East war. It's because of interest rates. It's because of this. It's because of that. It's because Biden's a failing president, whatever. It's got nothing to do. Everything is standalone. It's specific and it's clear, and doesn't use anything from the outside information, because that's a sure way to get into trouble. As soon as you have hope, you turn on the TV, you say, my position's not working well. Let's see what happens. Well, let's see what the experts are saying on CNBC. Well, I've been on CNBC. I know what the experts say. They come in and they say something. They say, we recommend this particular stock. It's a buy at 70. 6 months later, they're back on the air and they say, remember that stock we told you about? It was at 70. It's at 130 now. Aren't you happy? No, because when it was at 70, first it went to 50. You got the hell scared out of you. You got out of the stock, and now it's 130. So you have to have continuity. You have to have clarity. You have to have follow through, setup, trigger, and so forth. I'm going to show you how to do that with one of my methods. And first, I want to talk about the pillars of success. And this is something that most people don't think about, which I think is really important. Your first pillar of success will be methodology. Are you using a methodology that makes sense, that is specific and clear, that has rules to it? It doesn't matter what methodology you use. It could be a seasonal, it could be a cycle, it could be divergence, it could be stochastic, it could be anything. The methodology has to be proven correct, even 60% of the time, and you'll have something that is strong to begin with. The second pillar of success is philosophy. I know philosophy. What the hell is that about? Is that about religion or what? No, philosophy is, why are you trading? Are you trading to make money? Are you trading to prove something to yourself? Are you trading because you're broke and you need to make money really bad to stay afloat? Are you trading because you believe it's a good thing to do socially? Why are you trading? There's nothing wrong with saying you're trading to make money. That's great. I love it. Make sure you have an answer to the question of philosophy. The next pillar is psychology. I've talked about psychology here before, just today. And what I mean by psychology is behavior. So psychology is not really relevant. It's the behavior. What is your behavior? Psychology, of course, if it's really bad, if you're depressed and you can't get out of bed, you shouldn't be trading. You should be seeing a shrink. But there is no psychology in trading. There is behavior, and big difference, as I said before. Technology. Do you have the technology to do what you want to do? Meaning what? Meaning, do you have a computer that's going to do what you need? Do you have the right quote system? Do you have the right charts? Are your indicators accurate? Is your computer accurate? Is it reliable? Is it fast enough? Do you have a good connection with the internet and so forth? Structure. I already talked to structure as setup, trigger, and follow through. Then reality. And this is super important. Can you really do what you think you're doing? Do you have the time to do it? If you're a surgeon, should you be day trading instead of sitting in front of should you be day trading? Let me start again. If you're a surgeon, should you be trading intraday if you can't get to the machine on time? Should you be watching the screen while you're in the operating room? Believe it or not, I've actually had mentoring students who are doctors who say they want to day trade because they can watch the screen while they're doing surgery. Unethical, unacceptable, and something I wouldn't do. So be honest with yourself. Are you really a day trader or are you a position trader? Should you be day trading? Do you have the temperament for it, by which I mean patience and follow through? And last but not least, be honest with yourself. Look in the mirror and say, yes, I am a good trader. No, I'm a bad trader. Here's where I made mistakes. These are the shitty things that I've done in the market. These are the good things that I've done in the market. These are my strengths. These are my liabilities. These are very important building blocks of trading, and you would do well to go through them, but replace psychology with behavior. So let's talk about something. Seasonality. Seasonality is a methodology, and let me back up for a second. Seasonality is one way of putting specifics on the markets. I'm going to demonstrate to you what I mean by that momentarily, because seasonality fits into the picture of setup, trigger, and follow through. And if you take care of setup, trigger, and follow through, you will take care of the behavior. If you take care of the behavior, it will take care of you by giving you profits. If it gives you profits, you will have confidence, which will give you discipline, which in turn will give you more confidence, which will give you more profits. It's very simple. It's a virtuous circle. I'm going to skip this and let's talk about this. Honesty. When we trade, what do? We take risky action in the hope of a desired result. Think about that for a second. We take risky action in the hope of a desired result. That is the same as the definition of gambling. If you're going to gamble, do it right. Gamblers will make good traders. How's that? They know the odds, they know the inputs, they know the outputs, they know the players, they know the spread, they know everything they need to know. So let's face it. If we trade, we gamble. If we invest, we gamble. We're gambling on tomorrow because we are doing this, taking risky action in the hope of the desired result. So I'm going to share some facts with you. And by the way, in my spare time, I wrote 5 books on day trading. These are the best-selling books in the day trading world. But guess what? I am not a day trader. I'm not interested in it anymore. I want to work smart, not hard. So the trading model we talked about, setup, trigger, follow through. And let's talk about a few more things. In fact, let me do this. Just bear with me for a minute. Let's go to this chart. Here's a chart of 2 of my trading methodologies. Over here, we have what's called the moving average channel. Over here, we have what I call expansion and contraction. Let me get my pointer and see if I can do this correctly. Just one moment, please. I'm using a new pointer here, so I might screw up a little bit. Okay, here we go. We have here a 10-period simple moving average of the high, and over here, an 8-period simple moving average of the low. Notice these are not closing moving averages. They're high and low moving averages, okay? The reason we don't use closing moving averages is because they don't work. For example, the 50 and the 200-day moving average, called the golden cross or the death cross. If you backtest those on the computer, you find out that in the long run, the golden cross, 50-day moving average crossing above the 200, and the death cross, the 50 crossing below the 200, will give you results. In the long run, they will be profitable, but in the short run, they will kill you dead because they're very inaccurate, and they will take 13 trades in a row that are losing trades. And I can assure you that most traders, after the third loss, are not trading their strategy anymore. So we don't use closing moving averages. We use moving average 10 high, moving average 8 low. Combined with that, we use a trigger. Williams accumulation distribution, and its moving average 57. Very simple. And we've been able to program the computer to give us all the information we need because the rules are completely clear. And what would be those rules? If we get 2 complete consecutive bars outside the bottom of the channel, and notice I'm not using candles for the same reason I said before, TMI, too much information, 2 complete consecutive price bars below the bottom of the channel, and Williams goes below its moving average right over here, the computer tells me it's a sell right over there. The opposite situation, 2 complete bars above the top of the moving average right over here. Williams goes above its moving average right over here. Computer tells me it's a buy. This is so simple, even a computer can do it, as you can see. The other strategy that I use is called expansion contraction, for which we're going to have a webinar next week. And that is right over here. We use what's called the cone. The cone is a variation on the theme of the moving average channel and accumulation distribution. And it's very simple. It's red light, green light. I don't have any decisions to make. When the cone changes from red to green or from green to red, you get a reversing signal. Example, there was a buy right over here, right over here. There's a sell right over here. And we follow through to the downside. There was a buy somewhere to the left over here, and we follow through to the upside. The real money is made in the big move, and most people can't sit with the big move. They're always afraid. They're saying, "Oh, look, I finally made a trade that's making some money. I better get out while I've still got some money over here." They get out, and then they watch the thing double or triple over the next few days. That's not the way to trade. To be a good trader, you have to forget about everything you know as of this point in time, because it's probably the wrong information. I tell people to take the 10 trade challenge. Can you take 10 trades in a row, 100% by your rules or not? In most cases, you can't do it. So I say, okay, can you do 3 trades in a row strictly by the rules? Most people can't do it. Why? Because they've been doing the bad thing for such a long time, they don't know how. So I say, begin with 1 trade. Think about what it is that's scaring you about taking those 10 trades. In most cases, it's you're afraid to lose money. Well, that's an easy solution. If you're afraid to lose money, it means you've got too much money on the line. If you've got too much money on the line, trade fewer shares, trade fewer contracts. I tell people, there's nothing wrong with starting with 2 shares. Start with 1 share. Start with 3 shares. Give yourself that comfort level to the point where you can say, I don't care. Because I believe after all these trading that I've done all these years, to really make money in the market, you have to not care. The more you care, the less you'll make. And so, hold on one moment, let me go to the next slide. What I want to do is show you some current charts, and you'll see how this process works. One moment, please. Hang on one second. Come on, computer. Okay, these are a few other things that I would do. Let's do this. I'm going to show you a seasonal trade. So let me do this. I'm going to stop my share, and I'm going to go to a different screen. So bear with me. Okay, hold on, please. One moment. Hold on 1 second. I'm going to do this a little differently here. Just bear with me. I want to show you how easy this really is. It will take me just a moment to set it up. I'll be right back with you folks. Don't go away. Don't leave me. Here we go. I'll have the screen up and running momentarily. Okay, let me come back to Zoom and share my screen with you. One moment, please. We are almost there. Here we go. Okay, and you should see my screen right about now. Good. We're going to log into one of my websites, seasonaltrader.com. And I want to show you how clear this is. If I go to the futures, I can go to stocks or futures, whatever, doesn't matter. And I ask a question. For S&P futures, in the month of May, historically, since the start of trading, so we're talking about many years, has there been anything in the month of May risking 5% for a duration of 10 days or less? In other words, I'm looking for a short-term trade in the S&P that has been right 70% of the time or more, less than 10 days trade, 10 days or less, with risk of 5%. In other words, I'm asking a very specific question. There's no interpretation here. There's no ifs, ands, or buts. I'm asking for a pattern. Has there been a pattern? And if there's been a pattern, the computer will find it. So do a search. Computer says, yes, there has been a pattern. And this is what you asked for, Jake. This is the pattern. So what does the pattern say? And what I'd like you to do is compare this to what you know about your trading and what your trading strategy gives you. Computer has taken all of the combinations of the pattern I asked for, and it put the best one at the top position. It says, buying June S&P futures, close of trading May 23rd, getting out close of trading May 27th. We're talking 4 days with a 1% stop close only risk, has had a profit to loss ratio of 7.3 to 1, meaning in sum total, the winning has been 7.7 times higher, larger than the losing trades, with 77% accuracy. The average profit, 29 S&P points, the average loss, and so forth. And now what we can do is, and remember, this is a track record. It's based on hypothetical performance, but it's exact to the history. And here's the history. For the last 26 years, these are the results. So you'll notice that here we have everything that I told you. Within the context of what I said before, this is a setup. It's a pattern. Every pattern needs a trigger. One moment, please. I went back to the wrong location. Every pattern needs a trigger. The trigger in this case is what I call an 8 open close moving average. We take the open and the close, we compare them, and it gives us a trigger. And we'll be teaching that at our webinar. If you go to my website, jakebernstein.com, you'll find information on the webinar. So what else can I do here? I can look at the seasonal chart. Let me show you what I mean. Come on, computer, do your thing. It's crunching a lot of data here. So what it does is it shows the seasonal chart. It says this is typical of the June futures contract from 1982 to 2023. And this is the month of May right over here. And it's taking advantage of this little blip on the screen right here, 62% of the time higher during the last week of May. The good news is I can do this for stocks as well. So for example, I'm going to show you something really quite amazing. Seasonal trades, US stocks trades. I'm going to go to US stock trades. I'm going to go to the Dow Jones. So let's come down to the Dow Jones. And let's take the Dow Jones back in time. Because some people say, well, wait a minute, you've only got data for 25 years. Well, I assure you that having data for 25 years is about 25 years more data than most people use, because most people don't even bother to do the research. And part of building a structure that's effective is doing good research. That's what computers are for. So if I go to the computer and I say, can you show me, have there been any Dow Jones patterns for the entire year, any time of the year, that have been right 70% of the time or more, like so. Let me put it in there. With a risk of no more than 10%, like so. Have there been any? I go to search and the computer comes back and says, no, there haven't been any that meet those criteria. That's good information to have. So what about this? Do we need to risk more? How about this? Let's put a 99 in there and say, you tell me the risk to take, because we're not going to risk 100%. Just tell me the risk to take. Computer comes back and says, nope, there's nothing here for you. Great, I've learned some great information. So what do I do now? Come back to the computer and say, all right, let's go back further in time. And this you're going to find really interesting. So just hang in there for a second. Let's go back to the Dow Jones. In fact, let's go back to the, hold on one moment, please. Let's go back to the Dow. And let's go back to 1920. And say, maybe we're just not looking at enough history. Most people would go the other way. They'd say, just show me the last 5 years. I'm interested in as much data as I can get. So let's look. Computer says, yes, look at that. At the top of the list, we've got a trade that's been right 83% of the time since 1920. Buying, close of trading October 26th, getting out of close of trading January 10th. October, November, December, January. Who's going to hold a trade for 2.5 months unless it's a losing trade? Most people won't. But look at the accuracy, 83%. Is it perfect? No. But we have the history, and it's right over here. And by having all of this history, 96 years of history, show me who in this business will show you that. With an equity curve like this, no guarantees, but that is one of the best trades of the year. Very interesting. But most important is this. It's specific. It's a setup, trigger, follow through. So this is the setup. We need a trigger. In cases where you've got 80% accuracy or higher, I don't use a trigger. But if you want that warm, fuzzy feeling, wait for the trigger. As I said before, the trigger is an 8 open close moving average, which is very simple. I'll be teaching that at the webinar. And once we have that moving average in place, we get a trigger. And then there's follow through. The follow through is the average profit per trade. You see the average profit per trade is 375 Dow points or 6%. And you hit the trade. Once you hit the first target, you take some money off the table. You place the stop at break even. You place the trailing stop on the rest of the position, and you just let the damn thing go. Very simple. It's not perfect. It's not guaranteed, but it's a structure. And as I said before, even a bad trader with a good structure can make money, but a good trader with a bad, even a bad trader with a good structure will lose money, but a good trader with a bad structure can make money. So it's all about the structure, and that structure will take care of your psychology. But the most important thing I can tell you is this. If you're scared to make a trade, it means your position is too big. It means you're risking money you can't afford. There's nothing wrong with scaling down to 100 shares or 1 share or 2 shares or an option until you get it right, until you have the procedure correct. Now let me show you something else that you might find interesting. One of the best books ever written about the stock market is entitled The Behavior of Prices on Wall Street. I repeat, The Behavior of Prices on Wall Street. That book was written by a man named Art Merrill, Merrill. Some of you may already have that book. Merrill was way ahead of his time in the 1950s. What he did was he studied the Dow Jones statistics. How often does the Dow Jones go up in January, February, March, April? How often does it go down in October, November? What happens to the market when there's an interest rate cut by the federal government? Is there a relationship between major holidays and the stock market? Is there a relationship between presidential elections and the stock market? He studied all of these, and he came up with a brilliant conclusion. He found that the day before major U.S. holidays tends to be an up day 73% of the time or more. What does that mean? Example, Thanksgiving. In the United States, Thanksgiving is the last Thursday of November, which means that if you bought on the end of the day Tuesday and got out the end of the day Wednesday, in other words, the day before the holiday, your probability of making money was over 73%, which statistically, going back to the 1800s, could only happen by chance once in 10,000 times. It's a staggering statistic. How can we use that statistic? Well, I want you to think about this. We've got a holiday coming up at the end of May, Memorial Day. In fact, if I'm not mistaken, I think Memorial Day this year is the 27th of May. We can verify that by using this. Let me show you what I mean. I'm going to return to search right over here, and I'm going to go to S&P. In fact, let me do that a little. Let's go to futures. One moment, please. Seasonal trades, US futures, right over here. And we're going to go to the S&P file. And by the way, there's a lot more to this than I'm telling you. I cannot tell you everything that I've learned in 52 years of trading in 1 hour. Maybe given 5 hours, I could do that. Let's go to the S&P. And let's go to May. And we're going to ask a specific question. In other words, nothing unclear. We're not going to say maybe. We're not going to say could be. We're not going to say approximately. We're going to use exact numbers. Show me if there's been anything in May in futures that's been right 70% of the time or more. Tell me what my stop loss will have to be. So I'm going to put a 99 in here so the computer will find me a stop. And that's all I'm going to do. Is there anything in May? Let's ask the computer. Computer says that 92% of the time, buying June S&P futures, end of day May 25th, getting out end of day May 28th, has been right with a 13.6 to 1 profit to loss ratio and 92% accuracy. Realistically, can you expect this kind of accuracy? Well, I would say no, it's going to degrade at some point in time, but nonetheless, the statistics are very compelling. And here's the history right over here. Let me show it to you. All the way back to the start of trading in futures, 25 years. And here's what's interesting about it. I started teaching this strategy and revealing this strategy back in the early 2000s. What has happened since then? We've not only had the biggest trades ever, but it's been consistent. Why do I make that point? I make that point because people will say, oh, now, Jake, you've ruined it for everybody. You've published it. People know about it. Everybody knows about this. It's not going to work because everybody knows about it. It's complete rubbish. The more people know about it, the more they'll screw it up. So this is what it looks like right over here. Are there any other excuses? Some people will look at this chart and they'll say, it's gone parabolic. It's got to lose money. Besides that, we've got Biden, and that's no good. That's not important. What's important is you have the strategy. What's really even more important is this. How much are you willing to risk on this relationship? If this relationship is scary to you, nobody says you've got to buy 100 futures contracts. Nobody's saying you have to buy the E-mini. You can buy the E-micro. You can buy a call option. You can buy you can do a calendar spread. You can buy 10 shares of the spider. You can buy 1 share of the spider, but do something. In other words, study the history. So what am I trying to tell you here? I'm trying to tell you that if you have solid methodology, if you have setup, trigger, and follow through, if you have structure, if you have timing that goes with a pattern, you've got something that will give you confidence. Confidence will give you discipline. Discipline will give you profits. Profits will give you more confidence. And that will take care of the psychology. Because as I said before, there is no psychology here. There is only behavior. If you have the right behaviors, you will make money at the market. It's very simple. Let me show you something else. I'm going to go back to the search feature. One moment, please. And we're going to go to return to search. And we're going to ask the same question about a market like gold. Gold's been going up a lot lately. And in fact, it went up about 20 bucks today. Is there any pattern in gold at this time of the year? Let's find out. Let's go to May and gold, and let's do a search. Well, computer found something interesting. It says being short gold the 25th of May through the 26th, a one-day trade, has been right 78% of the time. Well, let's say that I'm interested in a bigger profit. I can sort this column and go like so. Sort this column by profitability. Show me the largest profitability trade. And that would be right over here. Long the 28th, the 25th, out May the June the 2nd. So here's a long trade with 73% probability and a larger average profit. So you can look at these numbers in a number of different ways, but the good news is this: you have the numbers. Most people don't have the numbers. Most people don't know how to do this. So what you want to do is get away from all this conjecture, get away from all the opinions, get away from all the news, and keep it simple. I'm going to do one more thing, and then I'll take questions, or we'll call it a day for me. You'll be rid of me. Let's go back to the seasonal and do another search. Let's go to S&P again. So let's forget about gold. And let's ask the other question about Thanksgiving. Remember, Thanksgiving is the last Thursday in November. So we're going to go to S&P. I'm going to say, show me seasonality for November. I don't want anything that has less than 70% accuracy. Tell me what the stop should be. And then remember, we're looking for a seasonal trade that goes up toward the end of November. It might start before Thanksgiving. If it does, the computer will find it, because many times this pre-holiday behavior is a very bullish behavior. So it's not just that the market will turn higher before July the 4th. Sometimes it'll turn higher June the 27th, June the 25th. And by doing this iterative search, using the capabilities of the computer, we can zero in on exactly the right time. And when we combine it with timing, that's when it becomes very powerful and gives you the confidence that you need. If you're the kind of trader who doesn't have confidence based on numbers, then you're in the wrong business. So let's ask the question for November. And the computer says, yes, we do have a tendency. And here it is. Let's sort it by accuracy. 88% of the time, November the 2nd to November the 6th, which is basically just 4 days. And here's the history. Let's take a look. There's the history, and here's the equity curves at the bottom. Quite impressive, I would say. And remember, the more data you have, the more data you can manipulate and extract data meaningful information from. And with artificial intelligence, you can do even better. So let me come back to the PowerPoint presentation. Just a moment, please. In fact, let me do this. Let me get a link. Just one moment, please. I'll be right back to you. And I will come back to the Zoom presentation. One moment, please. Just hang in there. I'll be right back to you. We're going to stop the share. I'm going to come back to a new share, so just hang in there, please. And here we go. Where's my PowerPoint? Here it is. And we're going to go full screen. And I will take questions on anything that I've covered today or whatever else. If someone relay the questions to me, I'd appreciate that. Well, let me open the chat and do it myself.
Hey, Jake. Yeah.
How will you use AI on this?
Yeah.
One can also download data from Yahoo. Yeah, right now, I'm not convinced that AI is enough to handle the problem because AI still hallucinates. But there will be some AI where we can use timing with this very effectively, and we are working on that as well. What is platinum doing? Platinum is on its way up. It's very strong. It's moving in sympathy with gold and palladium. The big move is going to be in palladium, however, because commercial interests have been buying palladium futures for a long time, and it's going to be an explosive market just like copper has been. Okay, any other questions? Oh, I'm glad you like it. It really is. It becomes even more awesome when you actually use it. I don't do lifetime memberships because if you want to do lifetime memberships, you have to ask yourself, how long is Jake going to live? So that is that is a link to the webinar that I'm going to be having on expansion contraction, which is a great methodology, especially if you understand when red changes to green and green changes to red. That's all you have to understand. So any other questions for me? David, I will turn it back to you, and thank you, audience. You've been very great. Appreciate it.